Yo, what's up YouTube? I'm back with another video, and today I'm going to be going over one of my favorite day trading strategies that I've seen plenty of consistency on, solid risk to reward, and today I just want to share that with you guys. So without further ado, don't want to waste a bunch of y'all's time. Let's get into it. So this strategy is pretty much a break and retest of our pre-market highs and our pre-market lows. Now, like I said in previous videos, I always want to know and make sure I mark out our pre-market highs and pre-market lows. I want to catch trend. I don't want to be caught in any consolidation, any chop in between these levels. So I always wait until we break above or we break below our pre-market high or our pre-market low. All right, so in the next slide, I'll be going over the checklist that I look for and that I wait for before entering on this type of trade. So like I said in the beginning, you want to mark out your pre-market high, you want to mark out your pre-market low, give us some sort of bias, some sort of direction on where the market is going for the day. After that, you want to make sure and wait. Keyword is wait and be patient for price to give you a candle close or a candle close above or below the pre-market high or the pre-market low. After you get that, you want to wait for your candle confirmation. Now this candle confirmation is very key. Depending on the setup, it'll pretty much show you and tell you if buyers have truly stepped in and we're going to continue to buy up, or if sellers have truly stepped in and we're going to continue to sell off. So after that, you get your candle confirmation, you want to enter in the trade, and then you want to put your stop loss above or below the candle that gave you the confirmation. So in the next few slides, let's go over some examples. All right, so on our first example, we see throughout the day, to open the day, we are pretty bearish. You can tell by all these red candles, especially this aggressive red candle. We try to buy up, we sell off, try to buy up, we sell off. So after that, you see we get our candle close below our pre-market low, and then we come down. Now this candle is a data candle, so you see the increase in volume. This is 10 o'clock data. It might have been consumer sentiment, I don't really remember, but that's what this candle is. Hence you see the spike in the volume and then the spike in the price action. So this is where experience comes from. I know I said wait for a candle confirmation, but with what I've experienced and the way that I've backtested this strategy, I did not wait for candle close. Why? Because I know that buyers were sitting down here. We tried to push down past 591, 590.5, and we bought right back up. So I know that this trade was going to be a little bit more of a scalp. So that's also something that you want to keep in mind, whether you're going to enter in for a scalp or whether you're going to enter in for a longer term trade. So again, we see closure below our pre-market low, we come down, we come back up, and this is our retest here. So once price tapped this level, we started to see a reaction out of our gap and out of our pre-market low. I entered in around here, I put my stop loss above here, and then I rode this puppy down for 591 and a half, 591 down to 592 and some change for a little scalp. I trimmed most of my position down here, put the rest in profits instead of going break even, again because I knew that there were buyers sitting down here, so I know that I was going to get a lot out of this trade. So that's one example. Again, you continue to see our sellers stepping in, driving the price down, but we don't get that follow through, and we reverse this little trend and we swoop on back up. So that's one of our first examples. For our next example, we pretty much have the same exact thing. Now this is one of my key levels that I had marked out that was on the higher time frame. So you see off the open, we hit it, rejected it, we came up, tried to buy up, rejected it. Our volume is also dying down as well, which means that these two green candles, that buying is not really supported well enough, so it's a pretty strong indicator that'll show you that the trend will be reversing and that our sellers will begin to step in. So that's pretty much exactly what you see here. See, we have one red candle here, we have an aggressive red candle here with more volume than the previous two, which again gives me conviction that we're going to keep on selling off. So this following green candle, this red candle here, we do close below our pre-market low. So that definitely gives me, again, more bias to the downside. But on this next candle here, we try to buy it up and we fail. So now I'm like, okay, now I'm just waiting for my fair value gap, retest into that pre-market low and entry to get short and take it down to the next key level. So that's exactly what you see here. We have an aggressive red candle down below our pre-market low. What we do is we don't tap it here, we tap it here, and again we tap it here, and this reaction here triggers an entry. So what I did on this trade, I think I entered in here as soon as we left the gap, put my stop loss above that candle confirmation wick. I then held it until we tapped our level, our key level. Now price does tend to move level to level. Now since our pre-market low and our key level was, pretty close, I got out most of my contracts here. So again, made a little bit of change there, but this just kind of shows you that this strategy does work a lot. Now if you held on to your contracts off of an entry here, obviously you see a more further move down. So it could have been a 60-70% trade, but I didn't catch all that. You probably won't either. Again, that's where experience and all that stuff comes from. So I'm still trying to learn, guys. Only been doing this for the last 2 years and some change now, so still trying to learn and critique my strategy to make it better and better. So now let's see an example of a break and retest of our pre-market highs. All right, now on this example here, I think this was February 25th, whatever. We do have our break and retest of our pre-market high. So again, guys, same thing as the last two slides, just flip upside down. We have our pre-market high, we get some momentum over, we get this candle close, which is very, very important. We get our break and our retest of this fair value gap, and again we close above our pre-market high, which gives us all the confirmation that you need to get in this trade. And then we ride it up to 597.6 up to 599. So now with this trade, I didn't wait for candle confirmation, because if I did this, I would have been an insane stop loss, like 597.6 down to 596.8. 80 cents on your contracts on SPY is not good. So in order to have a better risk to reward, I entered as soon as we left this gap here, when my stop loss was either, I try to keep my stop loss between 40 and 60 cents. So if I got in here 597 point, maybe let's call it 3, my stop loss is at 596.8. So 50 cents of risk, and what do we do? Bought it up. So from an entry here at 597.3 or so, up here at 599. That's a $2 move on SPY. Now if you catch that consistently, that could change your life. All right, depending on how many contracts you use, I'm starting to work on increasing size a little bit, trying to get some bigger returns. So again, pretty simple strategy, guys. You just want to wait for a break and retest of your pre-market high or low. We tap into a fair value gap and we ride it in the either direction. So that's all I got for you guys today. If you guys stayed for the whole video, thank you. I know it's one of my longer ones, so if you could do me a favor, like, subscribe, comment what you guys want to see next, and I'll be sure to try to get some more content out. All right, guys, that's it for me. See y'all in the next one. Peace.